Good morning and welcome to this Wednesday, July 13th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got a big inflation report today, and it was hotter than expected. Futures, which initially were up, I don't know, maybe I think I saw the NASDAQ at one point was up about 0.5%, or close to that. Anyhow, everything deteriorated very rapidly, and we're looking at a pretty rough open this morning. Of course, we've seen this a lot in 2022 with the big gaps lower, especially over the last 30 to 45 days. So I'm going to be more interested to see how the market trades during the day than I am at the open. But just giving you a sense of where we are right now. Looking at the diamonds in pre-market, down 1.17%. So that would equate, I don't know, to maybe 330 Dow points, something like that. The spider is currently down 1.33%. So it's down $5, over $5 in pre-market, from 380.83 at the close yesterday to 375.76. And the QQQ, the NASDAQ, getting hit the hardest, down 1.86%, down $5.33 to 280.91. It was down lower. It was down in the 270s. So it has come back up off the worst levels. But it was a hot report. We're going to talk about that in just a minute. But anyway, things are going to get off to a rough start this morning. We'll see where we go from there. I suspect, first of all, I'm going to go through a calculation in a bit with you on the inflation. And I will show you how I believe we are going to have a shockingly low inflation, at least headline number, next month. And I'll show you a little bit about that in just a minute. But anyway, let's go ahead and take you over to EarningsBeats.com. For those of you that are new, we'll go ahead and take a look at our website, because we do have a free newsletter. If you scroll down, go over to EarningsBeats.com, scroll down, you'll find the EarningsBeats Digest, name and email address, all it takes. Hit that subscribe button. There's no credit card required. You can unsubscribe at any time. 3 times a week newsletter, very simple read, just a couple paragraphs in the chart usually. Could give you a trading opportunity. Sometimes it's just education, things that I've learned over the years, but I think you'll enjoy the newsletter. And again, it does come out 3 times a week. Usually we try to get it out about an hour before the stock market opens. I know this morning I was a little bit late getting it to Aaron, so we probably got it out just a few minutes ago. But normally 8:30 is the time you would look for it. All right, let's take a look before we talk about the inflation report today and what we might expect. Let's take a look at what happened yesterday, because the market did see a bit of a sell-off yesterday. We saw the Dow Jones Industrial Average down nearly 200 points. S&P 500 down 35, NASDAQ down a little bit more than 100. Mid caps down 4, small caps down a point. Everything was down across the board. All 11 sectors were also down yesterday. Communication services was the best performer. It dropped 3 cents, so it was only 0.05%. So not much, but it was down. The worst performers were energy, losing almost 2%. Technology, 1.33%. Healthcare, 1.25, or actually 1.27%. And real estate, which dropped about 0.6%. Those were your primary losers. And once again, outside of healthcare, which was just coming down to test the moving averages, all the other sectors and all of our major indices all pretty much trading the same. The 20-day below the 50-day, and price action yesterday closed below the 20-day. So the only one that was, kind of bucked that trend that I'm showing you here is healthcare, which again was down to 128.75. Both its 20-day and its 50-day are in the 128s. So it's coming down right near both those moving averages, but all the others were below. I do want to point out, as I always do though, these AD lines still look incredibly strong to me. And that's based on where you finished the trading day relative to your trading range. If you're above that midpoint, your AD line is going to go up. If you're below the midpoint, your AD line is going to go down. And it's all dependent on how far near the top of the range or how far near the bottom of the range you finish, and also the volume. So it's that relationship times the volume that determines how much the AD line goes up or down every day. So if you have a really strong day, finish at the highs, volume's heavy, you're going to have a big move up in AD. But if you have a big down day, finish at the low on heavy volume, you have a big move down in the AD. The one thing that's different about the AD and the OBV, on balance volume, which a lot of technicians like to use, I prefer the AD line because the on balance volume doesn't eliminate the market maker manipulation. And I'm talking about these gap downs. Let me give you an example. If today we gap down on the QQQ near, well, let me go ahead and I'll just pull it up for you, show you where we are right now. So let's say we're at 281.27. Let's say we gap down to, we opened today at 281, down $5. And because of this huge inflation news today, volume is really heavy. And let's say we open at 281, we go down to 279 intraday, and we come back up and finish on the highs later today at 284 on massive volume. We would still finish down $2.24 from yesterday's close of 286 if we finish at 284. So your on balance volume is going to take all the volume, which is like I'm just assuming it's a heavy volume day. It's going to take all that volume and it's going to drop it. It lowers OBV. AD line, on the other hand, is looking at this. Oh, the range was 279 to 284, and we closed at 284. That's a very bullish for the AD line. The AD line will go shooting higher. That's where the differences come in between the AD line and the OBV, if you're an OBV fan. I prefer the AD line. I just think it's much more representative of what's actually trading and what's taking place. In this example, if we open at 281 and come back up and finish at 286.23, 1 penny below yesterday, I would look at that as a very, very bullish day. The AD line would take all this volume and drop it. And I don't know how you could look at this day, if that were the case, and say that it's a bearish day. And that's what the OBV does. Now, you don't usually have these kinds of days. Normally, the AD line and the OBV kind of go hand in hand. But when you have differences, I personally would tend to follow the AD line just based on the example I just gave you. 10-year Treasury yield. All right, so we had the inflation report come out this morning. So it was the June CPI that came out. And we were expecting on a headline number 1.1%, meaning that's before you strip out energy and food. That includes everything. We were expecting a jump of 1.1%. Came in at 1.3%. So 0.2% higher than expected, which is already high, by the way. May, to give you some reference here, May was up 1%. So June was already expected to go up to 1.1 and actually went up to 1.3. So there's your headline number. There's your clickbait for the media. That's what we're going to focus on. I can promise you. I've already seen it as a big headline over at CNBC. The core CPI in May was up 0.6%. We were expecting it to drop to 0.5%, but it actually went up to 0.7%. So again, it came in 0.2% above expectation. And hey, it is bad news. I'm not trying to sugarcoat it and say this isn't bad news. I just don't think it's going to last. And I think the way the market's been trading, I don't think it's worried about inflation. We'll see after today. I mean, if we have another big hot PPI report tomorrow and we sell off today and we sell off tomorrow and we go down and we break below those June lows, hey, maybe I'm wrong. Maybe that's what's going to happen. I just don't see it. Anyway, the update on the 10-year Treasury yield right now, we're up 8 basis points to 304. We were up to 307. We've come back down. I'll tell you, if we reverse back and that 10-year Treasury yield goes down with this kind of news, that is plenty of evidence for me that the bond market could care less about inflation at this point. And I'm going to talk about inflation a little bit more. I'm going to show you a chart of the inflation data and so forth. So I'm going to get into it a little bit more. I don't want to spend any more time on it right now. But just keep in mind the 10-year Treasury yield is probably one thing you want to keep an eye on today. I mean, if we finish at 320 today and we're up, 25 basis points, then yeah, I'm going to be taking notice. We're still going to be in this range, but that if you're somebody who's bearish the stock market and believes inflation is going to be a bigger problem down the road, that's what you want to see. You want to see the 10-year treasury yield soaring today and potentially tomorrow. A couple of really, I mean, kind of like we did back here around the last CPI reports that we had back in the middle part of June. You can see the big moves up. That's what you want to see again. And then we'll see whether or not the stock market, if that does happen, we'll see if the stock market can hold on to those June lows, which I believe it will. Just my opinion. All right, S&P 500, let's see where we are. So we've closed now 2 days in a row below the 20-day moving average. Today's gap down, not going to help that at all. So I think we are right now just consolidating. I mean, you can't say you're in an uptrend when you're below the 20-day and the 20 days below the 50-day. That's not the definition of an uptrend. So what I had hoped was going to happen is that the S&P was going to come up here, test this prior high, pull back, hit the 20-day, and go out back up to new highs. That has not been the case so far. So you can't really treat this right now, even though I believe we're going to go higher. You can't look at this right now as though we're in an uptrend. When you can't hold the 20-day, best case, you're sideways consolidating. So off of this downtrend, that's what I'm kind of looking for. Now we get back through the 20-day before we set a new low, and then I'm going to be looking again for that uptrend to start. But right now, I think you've got to respect the price action. Short term, we are below the 20-day, the 20 days below the 50, the 20 days rolling back over again. Very similar to what we saw back here at the beginning of June. Here we went through the 20-day in mid-April, and then, you know, we can see what happened when we rolled over, went down to new lows, here rolled over, went to new lows. The difference right now, for me anyway, is rotation. And I think the critical part today is going to be what happens if we do keep going lower. Is it those growth stocks leading? Is it the XLY that's performing poorly, much worse than the XLP? If those things are in place, then yeah, we could start another leg to the downside. I don't think it's happening, but again, you got to be open to all possibilities, regardless of what, you believe. So that's those are some of the things I'll be looking at today. So let's talk a little bit about crude oil. I don't know if you've noticed, but crude oil was up to $123 a barrel about 1 month ago. And now here we are at 95. That's $28 down. So it's about 23% decline in a month. Now, one of the things they highlighted in today's CPI report, I don't know if you read through it, but they talked about the surge in energy prices that lifted the headline number. Now, from my research, and this was a long time ago, I studied a little bit about the CPI and how it was calculated. So don't quote me on this. I need to go back and double check this, but I believe that the June CPI number includes the move in energy prices from May 12th to June 12th. I'm pretty sure it's the 12th of the month that they get their data from. So what they're looking at in this latest calculation, if I'm correct, and you might want to double check me on this, on the 12th of May, we closed, crude oil was at 106 per barrel. On June 12th, we were at, June 10th, we were at 120, 106 to 120. That's $14. That's roughly 14%, maybe just under 14% move to the upside in crude oil during this last period where we're calculating the CPI. Now, yesterday was July 12th. So now June 12th or June 10th, we were at 120.67. Look at where we closed yesterday, 95.84. What do you think that's going to do to the CPI number, that headline CPI number next month when it comes out? Even if crude oil goes back up to 115 or 120 a barrel, the report is going to be based on this. So, yeah, inflation, no question, was high, but we literally were doing it when oil was peaking. That's when the calculation was made. And now we're going to see what I think is going to be a much, much lower. We could even have a negative headline reading next month with energy dropping this much. Again, that's a 23, 28, 20. It's a 23% drop. That's got to have a massive, implication in the headline CPI next month. All right, speaking of CPI, here is the CPI. Now, of course, this does not include the June reading. So this is just through May. We'll have to update this for June. It would be 0.7 higher. So it's not 1% higher, which would take us up to about 295 and change. It's probably somewhere around 294.25 or something like that. Anyway, you can see we're definitely rising. Inflation has been a problem. We all know that. Here, the rate of change has jumped from 1.4% at the beginning of 2021 up to 6.5%. And because we came in ahead of expectations, if I go to my next chart here, I believe is the one I show you the individual charts. Yeah, so June of 2021, we jumped 0.8%. So even though we jumped 0.7, we're getting rid of, in the annual calculation, we'll get rid of that 0.8 and we'll add in 0.7. So we're actually going to drop on the annual rate probably to 591 or somewhere in there. These 0.8, 0.7s, whatever, these are all rounded. So you never know exactly, but we should be dropping below 6% on the annual. I didn't see the annual today, but that annual rate should have gone below 6%. And that's how it gets calculated. Now, think about what's going to happen next month, because I was worried the annual rate, the core rate. Now, of course, the core rate strips out energy and food prices. So I don't know that we're going to see the core drop the way the headline number will. But the headline number, and I think I can just get rid of this C. Let me see if I can. I think it's just CPI. Yeah, there we go. So right now, the core rate or the headline rate of inflation at the consumer level is 8.5%. And I'm assuming, let's see, down here, the monthly, June was, yeah, so we're replacing 0.88 or 0.87, whatever that number is right there, with 1.3. So we probably jumped another 0.4%. We should be up around 9% on the annual. And I think I saw that. I think I saw 9 or 9.1%. So, and that's why, because we just jumped 1.3% and we got rid of June of last year, which was, closer, it was under 0.9. So we tacked on at least 40 basis points, probably a little bit more. Anyhow, next month, July, the July number was somewhere around 0.45. I think we're going to see a negative number, or not very positive, not when you're dropping 23% in crude oil prices. So I don't know what we're going to focus on next month. We'll probably focus on the core, as far as the media goes, because I think the headline number is going to have potentially have a big drop. But just keep that in mind that, this isn't rocket science, the way they do these calculations. You get rid of the month from last year and you add the month from this year. Then that pretty much is your annual rate. So I think we're topping in the headline number. I think we may have already topped in the core number right here. I actually said back last year, maybe late last year, early this year, I can't remember exactly when I was talking about it, but I said I thought we would top with the March reading. And that's because April, May, and June had very big increases. You can see April April was up 0.9%. May was 0.75 tenths, and then 0.8 again in June. So I figured the readings this year coming up would be less than that. So the annual rate here would lose these big increases and be replaced with smaller increases. And that's what's happened. Well, the next few months are when we don't have very big rises, July, August, and September. So if we're going to go back up above the annual rate, in my opinion, it's going to be one of these next 3 months. And I don't think it's going to happen. I think we might do kind of like the headline number did. Maybe we rise a little bit, get close to 650, maybe not quite there. And then from there, I think inflation really starts to drop in the fourth quarter. These interest rate hikes are killing the economy. So you're automatically reducing demand. I mean, I think in another couple of weeks, when we get the GDP out, we're going to see that we get our second straight quarter of negative GDP. I think we're going to see that we're in a recession. And it's hard for inflation to continue when supply chain issues are being fixed at the same time demand is dropping and the Fed is raising rates. So that combination, I really think we're going to see the CPI start to come back down, the rate of change, the 1-year rate of change drop. Like I said, the next 2 or 3 months, we could drift a little bit higher. And then I think the bottom falls out of inflation. I don't think inflation is going to be the story. And I think that's what the market is already telling us. The market has moved on to recession. How bad's the recession going to be? That's what we're going to be talking about. You know, when we get our negative GDP, and then what that's going to do is going to change the whole narrative at the Fed. The Fed's no longer going to be worried about inflation and those 12 rate hikes they talked about. Hogwash. Now, I will admit inflation's been a bigger problem than I thought it was going to be. And I'll admit the Fed has already raised more times than I thought they would raise. But I also said there's no way they're going to raise 12 times, which is what they were forecasting. 9 times this year, 3 times next year is what I think they were saying. I think this month they're going to raise, especially after the inflation data came out today. That'll give them plenty of reason to raise one more time. And then that gives them the cushion to fight the inflation or the recession coming up. I think the next rate hike is going to be the last one, which is later this month. That's my prediction. We'll see. Anyhow, let's move on. So earnings might even finish a little early today. We'll see. But in earnings, Delta Airlines reported. And let me see if I can give you those numbers. I didn't have them earlier. I was actually having problems pulling up my source. I usually just go over to Zach's and look. Okay, I think I'm getting it now. All right, so Delta Airlines. And I don't know if, you know, I was talking about this stock the other day. Look at Delta. And I talked about how rapidly that its relative strength went down in 5 to 6 weeks. It went from a 52-week high down to basically about a 7 or 8 month relative low in 5 or 6 weeks. So clearly Wall Street was not expecting much in terms of their report. They went up, they tested their 20-day moving average and dropped a bomb this morning. 144 was their earnings per share. The market was expecting 171. So they came up 16 percentage points short of what was expected. And the stock was down, I want to say maybe 4 or 5% pre-market. Delta 7%. Yeah, back to 28.98. So looking at the chart, we're going to be all the way back down here near the low. I mean, this is one of the things I look at as we head into earnings season. I want to see what Wall Street is doing with these companies. Trust me, if these companies are having blowout quarters, they're doing great things. Wall Street meets with management. They hear from them. They go back and they buy for themselves. They buy for their clients. And as a result, you're going to see relative strength, not this. You're not going to see Delta underperforming the airline index by this wide a margin over a 5 or 6 week period right before they report great news. That's just not going to happen. Now, maybe they go up from here, but if you were expecting a big report, I would have asked why, because Wall Street wasn't, and they're the ones that have the access to management. I mean, that's just common sense. So I think we want to continue to follow the stock, but I would not be a buyer. One thing that'll help the stock, though, if it does gap down today, if it opens above, let's get this inspector out. So the low candle body right here was the open on July 5th at 28.62. If it opens at that level or above and then trades down intraday and comes back up and starts to set new daily highs, I think it can run short term, because I haven't looked at the options, but I am sure that max pain on Delta is going to be a lot higher than where it is right now after this big decline. There's probably a ton of in the money puts. So the gap down, doesn't surprise me, but don't be surprised because of options. And especially if we open at 28.62 or above, don't be surprised if later today at some point we start to rally into options expiration Friday. All right, what else do we have? Fastenal reported they were expecting to earn 50 cents. They earned 50 cents. The AD line's been pretty good, and even their relative strength. I mean, just recently we did pull back the last couple of weeks, but just 2 or 3 weeks ago we were at a 52-week relative high versus the peers. So I was kind of hoping that the company would have a pretty good report. They just matched estimates. It wasn't horrible, it wasn't great. And let's see, on a pre-market basis, we are at, down 4%, 47.99. So market not happy. Of course, market not happy with anything right now. So we're looking at opening down here, still above the support area. 48 to 49 has been the key area of support for Fastenal. We'll see. I would expect it to hold that level. But those were the two big names reporting this morning. Now, tomorrow, we will finally hear from, and I'm going to pull these up as your 3 you must see. So we'll wrap up with 3 stocks that will be reporting earnings tomorrow. And let's take a look and see what their charts look like. First one, got to take a look at JP Morgan. That's the kickoff of earnings season. Whenever JP Morgan's reporting, to me, that is the day that earnings start. We're seeing a lot more hollow candles. So, I mean, that's a good thing. Not a lot of big red candles like we saw here or like we had back in here on the big drops. So mostly we're just going sideways. The problem with JP Morgan is the AD line. Yeah, it's definitely put in a higher low since back in May. So as we've moved lower, starting to see a little bit of a shift there. So that is maybe a slight positive. I'd like to see the stock get back through the 20-day. And actually, let me pull it up on this other chart and see if it's got a positive divergence. It actually does. Lower prices, higher PPO. So I wouldn't be surprised maybe JP Morgan comes out with so-so report. I'm not expecting anything great. If you look at their relative strength, they were doing pretty well for a couple of months and then kind of drifted lower the last 5 or 6 weeks. I think it'll be an okay report. If we gap down, I would expect buyers to come in after that. I wouldn't be surprised to maybe head back up here to around 117 to 119 in the short term. That wouldn't surprise me after earnings. We might get a gap down on the earnings report, but then I would expect maybe a little bit more strength after that. Morgan Stanley, AD line kind of drifting sideways, which isn't bad considering the price keeps going down. Like JP Morgan, mostly hollow candles the last 30 days or so. Relative strength, showed a little bit of strength coming off the bottom here from April through mid-May, but now it's been drifting lower again. This is another one where we might get a so-so report. Maybe we go back down, test these lows, but from there, I expect it to actually drift back to the upside. And then the last one I have for you is, let's see, what other one do we want to look at? How about Cintas? CTAS is a different industry group. So looking at business support services, AD line, maybe at about a 6-month high or so, even though we've gone lower in price. Relative basis looks really strong versus its group. So business support services probably would like to see a really good report here. We're trying to trade up off of the 20-day moving average. I would give this one of the 3 I just looked at probably the best shot to report decent results, and maybe we'll see a gap up from Cintas. Anyway, that's it for today. I'm going to give you a real quick update on the QQQ and pre-market. Right now, it is back down close to the low, 280.32, down 2%. So that's down almost $6. I will say, again, watch the candle bodies. We've had a lot of hollow candles, even on days where we've gapped down. We've seen recoveries on some of these days, so I would be watching for that. We're going to open down here closer to this support level. Do we make a run later today? I don't know. Anyway, that's it for me. I hope everybody has a great day. We'll see what happens with this and then also with PPI and JP Morgan and the others reporting earnings tomorrow. Have a great day, everybody. Happy trading.